Good evening, friends. Happy to welcome you all to a session on a product which has gained traction in the last few months, ever since the taxation on debt funds was made at par with other fixed income products like fixed deposits, etc., by the budget of 2023 financial year. Also, there have been multiple changes that has affected this product category. And keeping that in mind, we thought that it is a great time to reassess our understanding about this category. Yes, friends, I'm talking about arbitrage funds. We are here to talk about the arbitrage funds, where we will talk about the concept of arbitrage. We'll also talk about the history and growth of arbitrage funds, and what is the current position as far as return expectations, the entire volume around arbitrage funds. To talk about all these, we have with us our co-head of hybrids and solutions, Mr. Bhavesh Jain. Bhavesh Jain has been with us for almost more than a decade, having worked his way from the prop side to investment desk, and has been managing the arbitrage fund since its inception. Welcome, Bhavesh.
Thank you, Deepak.
So, Bhavesh, what we would like to hear from you is the concept of arbitrage itself, just to refresh our memories. Also, how the product gets constructed and how the various constituents of the arbitrage fund works, and what is the current opportunity and current view as far as arbitrage funds are concerned, as far as Edelweiss is concerned. So, over to you, Bhavesh. Looking forward to a insightful session today.
Yep. So, good evening, everyone. See, arbitrage is nothing but buying and selling same thing or similar thing in two different market at same point of time. That is the, you can say, theoretical definition. Here, what we try to do is buy a particular stock in NSE equity segment and sell the same in NSE derivative segment. That is current month future, next month future, and try to capture the spread between spot price and future price, which theoretically is nothing but your cost of carry. Proxy of that can be your liquid fund return, which is again signaling what is your short-term interest rate in economy. Theoretically, return of arbitrage fund should always be closer to what your liquid funds are delivering. So you will see historically in 2014-15 period, when liquid fund was delivering you 8 to 9% return of arbitrage fund also in the range of 8 to 9%. During COVID, when interest rate went down to as low as 4 to 5%, return of arbitrage fund also went down to 4 to 5%. And now, after US started hiking rate and RBI followed the same, return of liquid fund as well as arbitrage fund both have touched 7.5% territory. So logically, return should always move in line with interest rate in economy, but there are other factors also which impact return of arbitrage fund, which we will discuss in some time. The basic construct of the portfolio is for every 100 rupees which we get, 65% is minimum what we try to put in arbitrage so that we qualify for equity taxation. And depending on whether the returns are higher than debt or lower than debt, we can spread our equity allocation between 65 to as high as 75 to 80% also. Remaining 20 to 25% will always be in fixed income, because whatever trade we do in derivative, like we are long equity and short derivative. So for selling that future or shorting that derivative position, we need to place margin with exchange. And this 20-25% which we put in debt is kept with NSE as a collateral for derivative margin. So 65 to 75% cash future arbitrage and remaining 25 to 35% in debt. First, the simple portion, that is 25 to 35% debt. As I told you, this is purely for, you can say primarily for, you can say margin requirement. That's why a large chunk of this will be either in T-bills or shorter GSEC, or like some other AMCs try to put money in their liquid fund or other fixed income fund, which are approved with exchange for derivative margin. At Edelweiss, we are very much clear that we will put this money into high quality AAA rated paper. Again, duration wise, because arbitrage is being used as a replacement to your shorter duration fund like liquid or overnight, and then some having maturity of funds having maturity of say anywhere between 3 to 6 months. We also try to keep our portfolio duration around 6 months. We don't want to take 5 year, 10 year duration call over here because people are not coming here as a replacement to your duration fund. This is purely a replacement to your liquid on a post-tax basis. That's why we try to keep our duration also on the lower end of the curve. As I already told you, high quality triple rated paper. So no credit call, no duration call. Equity, which is 65 to 75% of my AUM, is purely hedged. There is not even a single rupee naked exposure. We don't do any open trade. We don't do any special situation trade like IPO, open offer, merger, demerger, anything. We run a pure cash future arbitrage position. We buy underlying equity stock and we sell future of the same underlying stock. We are not even doing index arbitrage where we can buy constituent of a particular index and hedge it using that index future. We are not doing that trade. We are doing simplest form of arbitrage trade, that is buying Reliance, selling Reliance future, buying you can say Sun Pharma, selling Sun Pharma future. This is the trade what we actually do over here. Now, as I told you, there are multiple factors which impact this spread between cash and future. The most important one or the primary driver of this spread is interest rate in economy. So as interest rate moves higher, arbitrage spread also move higher, and when interest rate goes down, arbitrage spread also goes down. Other than that, there are few more factors which impact arbitrage fund spread. The second important factor is sentiment of equity market. See, in arbitrage, your primary trade is long equity, short future. So for every short position in derivative, you require someone who will go long on derivative. So for shorting future, you want someone who is buying future. Ideally, who will buy future? Who is either extremely bullish on market or wants to take a leverage position, or is taking purely a speculative, you can say, long position. So for that, the underlying sentiments of market has to be extremely positive. In bullish market, see, finally the entire return of arbitrage is the game of demand and supply. In bull market, demand for future will go up. You are a supplier of future because you always sell future. So in bull market, if demand goes up as a supplier, you will command a better price. And that's why in a bull market, returns of arbitrage are higher than return of liquid fund. That is why today you are seeing returns of as high as 7.5%, 8%, 8.5%, even in our regular plan. So second parameter of second factors is as I told you, sentiment of equity market. Third parameter is open interest in market. Again, open interest is nothing but, you can say, if I am long, say a particular stock, a quantity of say 1 lakh quantity, and someone is short 1 lakh quantity, then the open interest in market is 1 lakh. This shows that what is the total position in market, how much someone is long and someone is short. Today, that open interest is at lifetime high. We are close to 3 lakh crore. Now, that means someone is long 3 lakh crore, someone is short 3 lakh crore. As an arbitrager, we are always on the short side. So total AUM of all arbitrage fund put together is close to 1,65,000 crore. Assuming 70% of that will be arbitrage. So we are talking about a number of close to 1,12 to 1,15,000 crore. Now the total open interest is 3 lakh crore. We are less than 40% of total open interest in market. So though one may worry that AUM has gone up till 31st March 2023, we were at 80,000 crore. And today as we speak, we are at 1,65,000 crore. So one will definitely have a doubt that AUM has jumped significantly and as a result, spreads will collapse. But just to put in numbers in perspective, total open interest is close to 3 lakh crore and we are just 1,12 or 1,13,000 crore in arbitrage positioning. So we are less than 40% of total open interest. So still, I think till the time we cross 50% number, I think arbitrage spread will continue to remain attractive. So again, as I told you, one more factor is open interest in market. Third is positioning of HNI and retail. Today, you can say the highest long position in market is with HNI and retail. HNI and retail are purely, you can say, trader in nature or short-term participant in market who wants to ride this, you can say, momentum in the market. That's why they are long. So today, out of this total position of, as I told you, close to 3 lakh crore, if I look at net long position, HNI have net long position of almost 1,25,000 crore, which is highest amongst all the participants. followed by FIR long close to 30,000 crore. So HNI and retail are holding four times higher position compared to what the second largest participant like FIs are holding. Again, HNI and retail, as I told you, are purely, you can say, trader or speculator in nature. If they feel that a particular stock is going to give me 5%, 10%, 20% return, then they will not hesitate to roll over that stock at 10, 15, 20 basis point higher compared to the fair level. And that is why today again we are getting higher return because entire long position is dominated by HNI and retail. And if they are looking at 5, 10, 15% upside in a particular stock, they don't hesitate to give you 10, 15 basis point extra at the time of rollover. And that 10 basis point extra for us on an annualized basis is close to 1.2%. And that is why you see returns of arbitrage fund are continuously higher than return of liquid, even in an environment where AUM is going up significantly. But this long positioning from HNI and retail is taking care of all the higher AUM what we are getting because they are also increasing their long position continuously. Other than that, one more factor is your NDF spread. Again, just to simplify, what is NDF spread? An FI coming to India, he will convert his dollar into rupee, and for that, he will have to bear a hedging cost because whatever money he wants to make in India, it should not happen that he make 4-5% alpha in India by deploying money in India, and that 4-5% is taken away by currency depreciation. That's why they will hedge. If this hedging cost is higher, then FI will not come in India because say for example an FI is borrowing in US at 4% or 5% and doing arbitrage in India at 8 to 9%. So he's making 4% risk-free spread. Now, if his hedging cost is more than 4%, then effectively he's not making anything. So FIs will come in India to do arbitrage only and only if their hedging cost is under control. Today, that hedging cost is on the higher side because of interest rate movement in US, interest rate movement in India, plus a lot of geopolitical issues. Hedging cost is on the higher side. That's why FIs are not coming to do arbitrage in India. So in a way, again, that same picture of demand and supply come into picture. Your competition is low because FIs are not doing arbitrage. As a result of lower competition, you have a better command on the supply side of the situation, and that's why you are getting better price. So ideally, you will see all these 4 or 5 factors coming positive simultaneously. Happens very rarely, which is happening today. Normally, when interest rate goes up, equity market goes down, and as a result, sentiment becomes negative. But this is a first time where we have seen interest rates have moved up by almost 150 to 200 basis point from bottom of say 4.5 to 5% in 2022 to almost you can say 7.5% in 2024. But in the same time, equity markets have rallied, you can say, in the best possible manner. So these two things moving in the same direction is the best combination for arbitrage fund, and that is why today we are getting returns which are extremely positive. In addition to this, just to add, normally Jan, Feb, March, if you look at historical return of arbitrage, Jan, Feb, March gives you at least 1.5% extra return compared to remaining 9 months of the same year. Reason is one more factor which impact arbitrage fund, that is volatility of equity market. Historically, you will see all our tops and bottom are made in Jan, Feb, March quarter. That means markets are extremely volatile in this particular quarter. There are multiple reasons. First, this is a year start for FII. So they rebalance their portfolio, and as a result of their buying and selling, we see our markets become volatile. Second, historically, we have our budget in the month of February. So we have a pre-budget correction, a pre-budget rally, then budget-related announcement, and whatever positive or negative announcement is there in budget, we see reaction of that in the following month. That's why that is one more reason that markets are extremely volatile. Third, because it is financial year end, a lot of client, a lot of corporates don't want to carry a particular position on their, you can say, annual report, and as a result, they rebalance their portfolio. So that rebalancing also lead to, you can say, a wild swing both in interest rate in economy. So we normally see interest rate goes up in the month of March. And again, on the equity side, also a lot of prop desk are closing their book because of financial year end. And as a result, competition is less for arbitrager. So that also helps arbitrage fund to generate better return. So again, all these 3 or 4 factors coming together in this particular quarter, historically also, return of Jan, Feb, March compared to the remaining year is almost 1.5% higher. So we are already into Feb month, and we expect returns will be higher for both February as well as March. In addition to that, again, because government will announce their budget and to meet their fiscal deficit target, they will ask all the PSU companies to announce dividend. Historically, February and March are loaded with a lot of PSU companies announcing their dividend. That also is like an added advantage because we are long equity, so we are entitled to receive whatever dividend is announced by the company, and that dividend is like an added bonus for an arbitrager. So Deepak, all these factors coming together, I think this is the best time to deploy money in arbitrage. Even if you have 1 month view, 2 month view, you should definitely look to park money in arbitrage.
So, Bhavesh, ever since inception of Edelweiss Arbitrage Fund in 2014, we have done very, very well. In fact, we are in top three in terms of performance. How have we been able to manage this performance over such a long period of time? Point number one. Also, is it a correlation that if you have a large equity expertise or equity book, you will necessarily have the expertise to manage arbitrage fund? Because a lot of people think that अगर बड़ा है तो सब कुछ अच्छा है.
I think that is a very important point, Deepak. See, the skill set required for managing long equity and the skill set required for managing arbitrage is totally different. Today, you will see some of the largest AMC, their arbitrage fund is not there in top 5, top 7, top 10 performing fund. AUM wise, they may be there, but performance wise, they are not there because see, from 2005 till 2014, first 9 year arbitrage category was only 5,000 crore. The first arbitrage fund came in 2005, and in 9 years, the AUM was just 5,000 crore. As a result, a lot of larger AMC ignored this category. We launched our arbitrage fund in 2014 June. We garnered close to 58 crore in our AUM, and we were lucky. We launched it on 27th June, and on 10th of July, when NDA government led by Prime Minister Narendra Modi announced their first budget on 10th of July, they changed debt taxation from 1 year to 3 year, which in the latest budget has been taken out. The 3 year also has been taken away. But the first change was in 2014 July, where they changed debt taxation from 1 year to 3 year. And as a result, arbitrage as a category picked up from that point of time. So first 9 year from 2005 to 2014, only 5,000 crore AUM. And then 2014 to 2023 or 2024 first month, we are from 9,000, from 5,000 crore, we are at 1,65,000 crore. If you will see our own journey, from 58 crore, we are today at 8,300 crore. So change in debt taxation played a huge role. So when the first change happened, where debt taxation was changed, long-term capital gain tax was changed from 1 year to 3 year for debt, category grew from 5,000 crore to 80,000 crore till March 2023. Then the second change was made in March 2023, where this 3 year indexation benefit has been taken away completely. And within 1 year, we have seen category growing from 80,000 crore to 1,65,000 crore. Now, in this entire process, you will see smaller AMCs like Edelweiss or Invesco, all of these AMCs, which are not there in, you can say, pure long equity or in top 2 or top 3, 5 performing, you can say equity AMC. But look at the performance. We are there in arbitrage throughout, betting most of the large AMCs fund with a huge margin. Because the entire game of arbitrage is that execution, wherein fund managers or the dealing team is looking at for that last 1, 2, or 5 basis point, which a long only equity person is not bothered about or not concerned about. But as an arbitrager, you are fighting for that last 5 or 2 or 5 basis point, and that is the whole difference between you can say a top quartile performing fund versus others. If you look at our performance, we are just about to complete 10 years now. We are already completed 9.5 years. You look at any time period of our performance, 90% of the time, Edelweiss arbitrage fund will be in top half. If there are say 26 arbitrage fund, 90% of the time Edelweiss will be in top 13. Within that, almost 65% of the time, Edelweiss arbitrage fund will be in top 7. That is Q1. So the consistency of performance is very important while selecting an arbitrage fund. See, arbitrage is like liquid fund. One good month and suddenly your 1 month, 3 months, 6 months, everything looks good. And one bad month, suddenly your 1 month, 3 months, 6 months, everything looks bad. That's why you should never look at 1 month or 2 month performance because of any random trade, your 1 month return can be good or bad. We all look at least at 3 months, 6 month performance over a reasonable period of time. If there is a good arbitrage fund, because arbitrage is purely an execution product, if you are good at execution, then there is no reason that suddenly your rank will be 1 or 20 or 25 in different month. You should consistently be in top quartile, and that is something, top quartile and top half, that is something what we have tried to do consistently. And as a result, when you look at longer term performance, 5 years, 6 years, 7 year, 8 year, 9 year, and within next 4 months you will complete 10 years. Across time period, we are not only in top quartile, in fact, we are the best performing arbitrage fund with decent margin.
So Bhavesh, two questions. Uh, when we look at products, we also look at quality in terms of underlying portfolio. But when we talk about arbitrage fund, does it really a matter of concern if there is a quality stock or a not so quality stock? For example, if you hold a stock, of course hedged position, and the stock is in bad news for some reason, is in news for some bad reason, and the stock is plummeting 10, 20, 30%. How should an investor or a distributor react in that situation?
But that is the whole beauty of arbitrage fund. This is the only fund where we want our stock should be in news, negative or positive, because volatility is our best friend. Normally, as I told you, what is our trade? Say, for example, we buy a particular stock at 1,000 rupees and we sell future of that same stock at 1,010. Theoretically, this gap of 10 rupees is my profit, which I will realize if I hold this stock till maturity. When I say maturity, there is a monthly expiry, which is last Thursday of the month, like 29th February, 28th March, are last Thursday of February and March. So that will be the expiry day where this 10 rupees of that gap between cash and future will be realized by me. If the stock is highly volatile because of some negative news or some corporate governance issue or XYZ thing, this gap of 10 rupees, which suppose ideally should have come to me over next 28 days or next 35 days, if there are 4 or 5 Thursday in a month, can be realized in next 2 days or next 5 days. So I can move out of that stock and redeploy that same money into some other opportunity. So higher the volatility, better for us, because the same amount of money can be flipped and redeployed multiple amount of time, thereby generating higher return. As our positions are completely hedged, even if the stock is down 50% or there is some positive news and the stock is up 50%, neither we will make extra profit, neither we will lose anything. Our profit is fixed. That's why we say arbitrage is an alternative to fixed income fund, because when you talk about fixed deposit, your interest rates are fixed. When you talk about fixed income fund, your coupons are fixed. Similarly, when it is arbitrage, your spread is fixed. So whether there is a positive news or a negative news, the stock goes up by 50% or goes down by 50%, your profit will not change. Your profit will only be the spread between cash and future, which you captured at the time of executing the trade.
So Bhavesh, my next question is in line with what you have just mentioned. For viewers' understanding, assuming that you have entered into a cash future trade where you have bought a stock in the cash market and sold in the future market, and assuming you do nothing, you forgot about it, what will happen to the your position in terms of profit or loss at the end of the expiry?
Yeah. So again, if we take the same example, I bought the stock at 1,000 rupees. I sold the future at 1,010. And last Thursday of the month came. And because of XYZ reason, I forgot the stock, or I'm not able to reach the stock, or there is strike or anything. And then as a result, I'm not able to trade that day. Automatically, my short future position will get expire. And against that, the equity stock which I was holding will be delivered because there is a physical settlement. So even if either the stock, say there can be a situation where the stock is in ban, I cannot roll over. There can be a situation that the stock is going out of FNO. Then also I cannot roll over. So in all this scenario, you don't have to do anything. You have to just let your position expire. Automatically against that short future position, your stocks will get delivered. You will be out of the position without doing anything, even if you forgot, even if you are not able to trade, or even if there is no future going forward, because the stock is moving out of FNO.
This is a perfect example of getting an arbitrage and its return realized. There are cases where we roll over positions, and either you may end up getting the returns that you logged in, or sometimes little less or more. If you can explain that phenomenon, which happens only because of fresh rollover, how does that work in favor or against an investor?
So normally,
also, Bhavesh, let me make this announcement. I would request participant to send in their question on the chat box, and we will take them after this question.
Yeah, I think see, normally once we enter the trade, we can either square off our position, we can let it expire, or we can roll it over. So square off position is very simple. We are long equity, short future. So again, we will sell equity and we will buy the short future which we have sold. That will happen, as I told you, in case of a volatile stock where this 10 rupees spread, which ideally should have come to me in by the time of expiry, is getting realized in next 5-10 days itself. So I will just square up the position and redeploy that cash in any another available opportunity. Expire, as I told you, if rollovers are bad, if the stock is moving out of FNO, if the stock is in ban, there can be various reasons, or there is some redemption, I want cash. So in all this scenario, I will just let my future position get expire and automatically cash will also go. Rollover is when I want to continue with my position and I'm able to, you can say, shift my position from January to February, February to March, March to April, and I'm still getting returns which are better than, you can say, other available opportunities in market. I will just keep on rolling over my position. Trading in equity is very expensive. Trading in derivative is very cheap. When I buy and sell a particular stock, when I in equity segment, I pay 20 basis point purely as STT. 10 paisa while buying the stock and 10 basis point while selling the stock. So 20 basis point only STT plus brokerage, which is 3 basis point on each of the leg. So it is 26 basis point in just trading equity. Whereas when it comes to derivative, I pay 1 basis point brokerage on buying future. That is, I will buy my January future and I will sell February future. So 1 basis point for buying future, 1 basis point for selling future, and only 1.25 basis point for STT while on the sell leg. So my round trip cost on rollover is around 3.25 basis point versus my round trip cost to move from stock A to stock B is as high as 26-27 basis point. That's why most of the positions gets rolled over. Now, at the time of rollover, there are few factors which can impact my returns. First, as I told you, sentiment of equity market. If sentiments are extremely positive, rollovers will be higher. You will get better return, like what we are getting for last 6 to 8 months now. Sentiment is extremely positive, so rollovers are very good. As a result, you are getting better return. Then another factor which impacts, as I told again, there are few months where there are 4 Thursday. There are few months where there are 5 Thursday. Like in February, 1st February, 8th February, 15th, 22 and 29. We have 5 February in the month of 5 Thursday in the month of February. As a result, rollover spreads normally are slightly on the lower side for a 5-week expiry compared to a 4-week expiry, because people roll over at absolute level. Say, for example, I am rolling over my position at 10 rupees. Now, 10 rupees for 28 days is a different number versus 10 rupees for 35 days is a different number, because we are looking at annualized return. That's why smaller expiry and longer expiry can also make a differentiation on your rollover spreads. Again, market volatility, because all your NAVs and all your inflows outflow are on the basis of closing NAV or closing price of a particular stock, which is nothing but last 30 minutes volume weighted average price of NSE equity and NSE derivative. Because NSE equity and NSE derivative are two separate, you can say, market. Sometimes it happens that they are closing in equity segment and in derivative segment because of some block deal, because of higher volume, because of lower volume, cannot be in sync with each other. And that's why sometimes you see we as we say that we have captured 8%, but 1% is already realized in this month, or we have captured 8%, but we will still get 9% because of 1% of last month will also get realized in this month. So because of that mark to market phenomena, your returns can move 1% here and there. And then that is why we always say come at least for 3 months, 6 months, so that this mark to market things get average out over a reasonable period of time. But for 1 month, if you are coming for 1 month, that is the reason we always say come closer to expiry week, redeem closer to expiry week. If you are coming for 3 months, 6 months, 12 months, you can come on 1st, you can come on 8th, you can redeem on 15th, you can come on 12th. As and when you want to enter and as and when you want to exit, you can do that. Because in arbitrage, anything about 3 months is like long term. So for long term, your entry and exit doesn't impact your performance. But if you're coming for 1 month, 2 months, and 3 months, then try to come closer to expiry and redeem closer to expiry.
So, Bhavesh, I would urge investors not to look at arbitrage fund for less than 3 to 6 months. For that, I think a liquid fund or a ultra short term fund could be better suited. Ideally, you should come for more than 3 months, and more than 6 months is even better. The experience would be much more smoother. Bhavesh, two more questions on risk, and then I'll start taking audience question. One is with regards to the risk that can be, visible, that is visible as far as fixed income portion is concerned. So in past, we have seen some people have taken credit, Some people have taken duration. What is your advice? And what do Edelweiss do? You've already explained, but for the benefit of our partners, if you could further explain that. Also, how do you how are you protected from a fat finger trade? For example, I mean, you understand a fat finger trade, but for the
Yeah.
benefit of partners, if you hold 1 lakh shares, but you have redeemed, or if you have sold 10 lakh future against it, how those kind of anomalies can be protected? How is the risk management functioning at that level?
Sure. I think in arbitrage, no one should not be bothered about the equity portfolio because entire equity portfolio is hedged. One should definitely be more cautious on the fixed income side. Though people think that fixed income is, you can say, relatively safe, but for arbitrage, historically, if you will see in 2018 when ILFS and DHFL crisis happened, there was an arbitrage fund which gave you negative return because they were holding DHFL paper and that defaulted. As a result, your NAV was negative. Similarly, in 2020, March, at the time of COVID, when lockdown was announced, at that time also some arbitrage fund which were having long duration and they were forced to unwind their position because we saw almost 40% redemption in just 2 weeks across category. People were forced to liquidate their fixed income portfolio at a you can say, levels. And as a result, again, we saw that some of the arbitrage fund gave you negative return. Theoretically, arbitrage fund should never give you negative return if you are holding that position for the entire expiry. But as the time of COVID, where people were forced to redeem in between because there was a lockdown announced, and as a result, people wanted liquidity. There was a month where we saw returns of arbitrage fund were even negative. That's why fixed income portfolio is something which you have to be very careful. At Edelweiss, we have a return policy where we say that all our investment will be into AAA rated paper. We will not take a duration call. We will not take any single paper having maturity of more than 3 years. Average maturity will be 6 months plus or minus, you can say 3 months. Again, as a no conflict policy, we don't deploy money in any of our group company also. So as you know, Edelweiss Group have many, you can say, sister companies, but as a no conflict policy, we don't, you can say, deploy money in any of our group company. And again, for transparency, if you see, we don't have to wait for your fact sheet or monthly portfolio disclosure. We publish our fixed income portfolio every Monday on our website. So you can look at that portfolio because according to us, the biggest source of risk for all hybrid funds, not only arbitrage, even equity saving, even balance advantage fund, is their fixed income portfolio. And that is why we publish our fixed income portfolio for all our funds on our website. Now, as far as execution risk is concerned, where, as you said, that instead of 1 lakh shares, 10 lakh shares are getting traded, or because of any XYZ reason, one of the leg is not getting traded. So just to put in things in perspective, all our trades are routed through brokers. As a mutual fund entity, we are not allowed to trade directly, though there is a consultation paper from SEBI, but this is still, you can say, in discussion. Nothing has been finalized. So as of now, all trades, not only for us, for all mutual funds, all the trades are routed through broker. Broker takes the end responsibility. If I say that do arbitrage of say 5 lakh shares in Reliance, end of day, he is supposed to give me 5 lakh quantity, which is perfectly hedged. If there is any deviation that instead of 5 lakh, he has bought say 5 lakh cash, but sold only 4 lakh 50,000 future, then we are not compulsory. We don't have any compulsion to take that position in our book. We can directly reject the trade. It has happened many times that because of operational issues, because some stock suddenly goes into a circuit for a few minutes and then it opens after some time. Because in FNO there is no permanent circuit, there is circuit for very few seconds or few minutes. And in the meanwhile, if there is some stock which has remained unhedged, the entire responsibility lies with the broker. They make sure that they don't enter into a trade where any position has remained unhedged, and that's why we don't have any operational risk at our end. If at all there is some mistake at the broker's end, we have all the, you can say, power to recover whatever losses has been incurred from the broker. And then brokers are also extremely mindful of that, and that is why you would have never heard in you can say almost 1,60,000 crore industry doing rollover every month of almost 2 lakh to 3 lakh crore. But till date there is no you can say operational hiccups, which has happened not only with Edelweiss, across industry with any arbitrage fund.
Thanks a lot, Bhavesh. I'll start taking audience questions. Mr. Varun Asher from Optimus asks, what's your view on how will arbitrage funds be impacted by change in taxation, if any? So if equity taxation also goes away for arbitrage, what happens?
I think, see, this is from, I think, if I'm not wrong, from 2018 onwards. Whenever there is budget, this apprehension, this doubt, this nervousness is there in market, or you can say rumors are there in market that taxation for arbitrage will also change. I think, see, as of now, if you look at overall market volume, if you look at overall liquidity in market, I think the large cap and large and mid cap space is extremely liquid because a lot of arbitrages are there in market to make sure that proper price discovery happens. If at all government changes the taxation, it will not be, you can say, a particular category that they will pinpoint arbitrage, because taxation will be in line with equity taxation. So like earlier, there was no long-term capital gain tax for equity, so there was no long-term capital gain tax for arbitrage also. Then when 10% long-term capital gain tax came for equity, the same thing was applicable for arbitrage also. So if at all anything will happen, it will happen to the entire equity bucket. Uh, Again, we cannot speculate, or we don't know what, when and when it will happen. But I think the market is extremely efficient. Today, the spread is 7% because interest rate in economy is 7%. That's why post-tax return of arbitrage is also 7%. Tomorrow there is taxation, then obviously this spread of 7% will move up to maybe 8% or 9%, so that effectively post-tax again you end up getting that 6 to 7% spread. So there can be 10-15 basis point returns which can be lower or higher because of, you can say, change in taxation. But I don't think the category will get over, because see, as an arbitrager today, I am happy to roll over at 7% because 7% is my benchmark. I'm able to beat most of the fixed income fund if I get 7%. If tomorrow my taxation is also like any other, you can say, fixed income taxation. So for me, that 7% hurdle rate, to get that 7% hurdle rate, I will roll over only at 9% or 10%. Otherwise, I will not roll over. And as a result, as I told you, this is a game of demand and supply. If all the arbitragers decide not to roll over, automatically the spread in market will move to 8%, 9%, and 10%. Because it is the game of demand and supply. It cannot happen that one leg of the market will get impacted without having an impact on second leg. So if tomorrow, say suddenly everyone becomes bearish on market, your long person, the person who is long on market, he will stop rolling over his position because of mark to market losses. Automatically, as an arbitrager, you will also suffer. And the same thing is true on the other side also. If tomorrow, because of taxation, I am not able to roll over at 7%, I'll be forced to roll over at 8, 9, 10%, then automatically that long roller has to bear that higher cost, because finally he's playing for 10%, 15% return in 1 month, 2 months. So instead of rolling over at 60 basis point, he will happily roll over at 70 and 80 basis point also, if at all that situation arises.
Also, most tax changes have been on prospective basis and not on retrospective. So that also people should keep in mind. Shanai Aras from Credel asks, please explain how interest rates affect arbitrage spreads with an example.
Again, I'm taking the same example. Say, for example, a particular stock in equity is trading at 1,000, in future is trading at 1,010. That gap of 10 rupees is, just in simple term, it is 1% spread. Now, assume both cash and future are trading at 1,000 rupees. There is no spread. Both cash and future are 1,000 rupees. Then no one will go and buy equity, because for buying equity, you will have to pay entire 1,000 rupees. Only then you can buy 1,000 rupees worth equity stock. Now, say for example, you, me, we all have some positive views in a particular stock. Say that stock, just for example, is Reliance. We all have a positive news in Reliance. Reliance is trading at 1,000 rupees. Reliance future is also trading at 1,000 rupees. Now, if I have only 1 lakh rupee with me, I can give that 1 lakh rupee to my broker and I can buy 100 shares of Reliance, assuming say price is 1,000 rupees. Now, you also have 1 lakh rupee with you, but what you will think, instead of buying equity only, you can say only 1,000 quantity, only 100 quantity, why don't I give this 1 lakh rupee to my derivative broker? He will take 25% as margin and give me 4x leverage. So with that same 1 lakh rupee, I can buy Reliance future of 4 lakh rupees. So now there is a huge gap. The person who is buying equity is able to buy only 100 shares. The person who is buying future is able to buy 400 shares with the same 1 lakh rupee. So his profit will be 4 times higher. Now again, the basic concept of demand and supply will come in picture. No one will buy equity because you are able to buy only 100 share. Everyone will go and buy future. So automatically demand for future will go up. Demand for equity will go down. As a result, future from 1,000 rupees now will start trading at 1001, 1002, 1003, 1004, 1005, because everyone will go and keep on buying more and more position on derivative side. Now assume cash remained 1000, future became 1050. I'm just taking a hypothetical example so that it becomes easy to understand. Future became 1050. Even now, one will still think that even if I pay 25% as margin and the price is 1050, I'm still able to buy three, you can say 3.5 times more position. So both of us will make equal amount of money, but I will make 3 times more because of leverage. So even at 1050, people will buy. But now here comes the angle of interest rate. Someone is buying future at 1050. What you will think, rather than buying future at 5% premium and paying 50% purely as you can say premium, which is 5%, better I will go to my friend, I will go to my relative, or I will go to a bank and borrow 3 lakh rupees from them, and I can buy 4 lakh worth position now. 1 lakh which was there with myself, and 3 lakh which I have borrowed from my relative or from bank or any other place. Now I have 4 lakh rupees in cash. So I will go and buy Reliance equity at 1000 rupees rather than buying Reliance future at 1050. So the whole game of demand and supply will now change. Now suddenly everyone will realize that rather than paying 5% premium and buying future at 1050, we will go to our friend and borrow money at 1% interest rate and buy equity. So now demand for Reliance future will go away and demand for Reliance cash will come. So this 1050 future will come to 1040, 1030, and this 1000 rupees cash will go to 1010, 1020. Again, now the gap will be 1000, say cash will be 1020. When I say cash, Reliance equity. Reliance equity will be 1020, Reliance future will be 1030. Again, back to that gap of 10%. Now again here, the same equilibrium will come into picture. Now, even if I borrow money, I have to pay 10 rupees, which is 1% as interest to my friend or to my relative. And then you have to enter into an agreement, loan and all that stuff. So better I will pay 1% as premium and buy future. So till the time future and interest rates are equal, I will be neutral. I can buy equity also, I can buy future also. The moment future goes at a premium which is much higher than the interest rate in economy, everyone will go and borrow money from bank and try to buy equity rather than buying future. And if future goes, you can say lower than interest rate, then no one will buy equity, everyone will buy future. That's why interest rate and spread between cash and future theoretically should move in same direction. The only difference will be 50 or 100 basis point purely because of bullish sentiment and bearish sentiment in market. That's it.
So, Bhavesh, is it true that an arbitrage trade can also be converted or at least renamed as a lending transaction where, let's say, taking your example of Reliance, you have invested 1000 rupees. The security is the collateral is the share, the coupon is 10 rupees, and the tenure is 1 month. So it is basically a fixed income security where you will not get more than 1% and you will not get less than 1%. The borrower is exchange in that sense because the exchange is settling the trade. So can it not be construed that actually an arbitrage trade is basically a fixed income instrument?
So if you will see earlier when exchange and all that derivative markets were not there, there was a concept of badla trading. This is purely a badla trading in an electronic
Vyaj
format.
badla.
And it is purely Vyaj badla, or you can say badla trading in electronic format. And instead of, you can say, trading only in equity, there is a future market where another security is already there with you. So it is purely, as I told you, a replacement of your fixed income investment. Like in fixed income, you have fixed coupon, you have fixed interest rate. Similarly, here you have a fixed spread. So your maturity date is fixed, your spread is fixed. So actually, you can treat arbitrage as an 28 days or 35 days FMP or FD, which will get rollover every expiry.
But still, Bhavesh, we would like to understand the movement risk in terms of NAV compared to a ultra short or a liquid, which may be more linear. And hence, we are saying that 3 to 6 months is better. So if you could explain the difference between liquid ultra short versus arbitrage in terms of daily NAV movement rather than a 3-month NAV movement.
So assume that, say, liquid fund is giving you 60 basis point return and arbitrage is also giving you 60 basis point return. So there are 30 days in a month. So your return of liquid fund more or less will be 2 basis point per day. It will be very linear. But in arbitrage, because as I told you, cash market closing is last 30 minutes of NSE equity segment. Derivative market closing is last 30 minutes volume weighted average price of derivative segment. Both of them can move into different direction because of some block deals, some announcement, higher volume, lower volume. And that's why your daily NAV is more volatile compared to your liquid fund you can say liquid fund NAV. Liquid fund will give you 2 basis point on a daily basis. So 30 days, you will make 60 basis point. In arbitrage, because of this mark to market, what we normally call your daily NAV is calculated using mark to market. That means all your positions are getting marked to the daily closing price. There can be a days where you are getting negative 10 basis point as return. There can be a day where you will get positive 10, 15, 20 basis point as return. Just to put example, if you look at yesterday's NAV of all arbitrage fund, it was around 13, 14, 15 basis point. If you will look at today end of day NAV, which will get published in the night, returns will be negative 8, negative 10, negative 12 basis point. So if you add 2 days, you are making 4 basis point, which are equal to liquid. 2 basis point for 2 days, 4 basis point. But the way your portfolio will show, one day negative 10 basis point, one day positive 14 basis point. So volatility will be much higher. And that's why we say 1 month return of arbitrage fund, because of this mark to market or this NAV calculation, can be random. And if you stay longer, you stay for 3 months, 4 months, 6 months, this gets average out. And that's why you will not find that volatility when you are looking at 3, 4, 5 months, because in arbitrage, as I told earlier, it is known as long-term investment. 3, 4, 5 months is long-term. And in long term, all this volatility gets averaged out and you are not impacted. But for 1 month, definitely it can have an impact of almost 100, 150 basis point on your expected return. And 100, 150 basis point can be huge, particularly earlier when return was as low as 4 to 5%. 100, 150 basis point here, and then your returns can go down to 2.5% also, and your return can go up to 7% also. Today, when returns are almost 8, 8.5%, 1% here and there, it can still be in the range of 7 to 9, which is still better than liquid. That's why today we are saying, even if you are looking for 1 month, you can come for 1 month deployment also. But that is only in today's scenario where returns are as high as 8 to 9%. But historically, when returns are average, say 6, 6.5%, 1.5% swing because of mark to market can change your return profile dramatically. And that's why we always say come at least for 3 months.
Also, there is a question with regards to ideal investment horizon. I would suggest not less than 3 months. People should not look at arbitrage fund because of this daily NAV movement could be different. But over 3 months, this all gets evened out. Also, I would like to request people not to start their STPs immediately. Wait for 1 month and then start your STPs. Unlike a liquid plus or a liquid fund where you can start it immediately, I would recommend always a 1 month holding period before you start your STPs, etc. from arbitrage fund. Final question, Bhavesh. How does one really select an arbitrage fund when returns are not too different? How exactly one arbitrage fund is different than others?
So I think, Deepak, I already mentioned consistency of performance is extremely important. Someone is taking a duration call, and when duration goes in his favor, there is sudden, like what happened in last, you can say couple of weeks, suddenly there is 10, 15 basis point, you can say correction in interest rate. You will see suddenly those funds taking duration are becoming number one, number two. And the same thing can go against you when interest rate hardens further. So that's why if anyone has taken a duration call, a credit call, or some, you can say, random position in their portfolio, their 1 month return can be very good. But sometimes that trade will go in their favor, sometimes that trade will go against them. That's why 1 month return can be good or bad, but 3 months, 6 month return will always be on the lower side. So what ideally we say is look at rolling 6 month return of all the arbitrage fund. Look at for last 1 year, 2 year, 3 year, 5 year, as long as you can see. Look at this data and look for consistency of performance. When I say consistency of performance, again, if there are say 24 arbitrage fund, ideally your fund should be in top 6 performing fund, that is Q1, top 25% of the fund across time period, so that you don't get negative shock. That you look at a fund today, that fund is rank 1, you will enter looking at that rank 1 performance, and by the time you enter and your 1 month or investment period of 1 month, 3 months, 6 months, it gets over. By the time the trade because of which his rank was number 1 suddenly goes against him, like interest rate from 7.2 went to 7, you enter at 7, and then again from 7 it went to 7.2, you may end up losing money. or you can say at least you may end up getting underperformance. And that's why look at consistency of performance. Second, please look at fixed income portfolio of all the arbitrage fund when you are selecting. No matter they say that we have only 1% in AA rated paper or only 1.5% in a B rated paper, it will not impact the portfolio. Then you should again counter argue that 1%, even if it goes in your favor, will not impact the portfolio. Then why to take that even 1% position also? Because if you are talking about a product where your expected return is 6 to 7%, even if 1% gets, you can say, wiped off because of mark to market or because of credit default or any other stuff, that is like 15% of your expected return. So you should not look at a 1% position. You should look at it with the lens of 15% of my expected return. And you have to keep in mind while selecting any arbitrage fund the quality of the fixed income portfolio.
So thank you so much, Bhavesh. Thank you for your valuable insights. Thank you everyone for participating. Just to conclude, Edelweiss Arbitrage Fund has been in existence for almost 10 years now. The current AUM is close to 8,300 crores. Across time periods, we are quartile one, as Bhavesh so well explained. In terms of short-term performance, 1 month, 3 months, 6 months, and 1 year, we are ranked 1, 3, 3, and 4. So thank you so much, everyone, for participating and taking time out. We really appreciate your patience with our comments and questions. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.